The most dangerous moment for your money is not when you are broke. It is the moment right after your very first real win. One wrong move now can erase years of progress overnight. Stay to the end. The deadliest mistake looks exactly like winning. Hey, my name is Sargon, and behind this skull is somebody who has watched more people destroy a rising fortune than ever build one. Here is the brutal truth. Making your first real money is hard, but the danger does not end there. It begins there. Today, I am going to walk you through the exact things you must not do the moment your capital finally starts to grow. Mistake number 1. Celebrating with your lifestyle. The first real money arrives, and the instinct is to upgrade everything: the car, the apartment, the watch. This is lifestyle creep, and the data shows where it leads. The U.S. personal savings rate has slipped to around 4%, even after years of rising incomes. People earn more and somehow keep less. Your reward for winning becomes the reason you lose. Mistake number 2, and this one is a killer: going all in on a single bet. After a first win, confidence turns into recklessness. You find one hot stock, one coin, one can't-miss idea, and you pour everything into it. That is concentration risk, and it is the fastest way to turn a good start into a total wipeout. Let me show you exactly how brutal it gets. The numbers are unforgiving. Investors concentrated only in tech stocks during 2022 watched their portfolios fall more than 30% in a single year. And here is the hidden trap of 2026. Just 7 companies now make up about 35% of the entire S&P 500. Millions think they are diversified in an index fund, when really they are betting on one crowded trade. Mistake number 3 is the silent wealth killer: letting your emotions trade for you. When the market drops, fear screams sell. When it rockets, greed screams buy more. Both feel like smart, decisive action. Both are usually the exact wrong move. The cruel irony is that the more you try to protect your growing money by reacting, the more of it you quietly destroy. This has a name and a price tag: the behavior gap. For decades, researchers tracked how the average investor performs versus the market itself. Over 30 years, the average equity investor earned around 7% a year, while the market returned closer to 10.5%. That gap was not bad funds. It was bad timing. Humans buying high and selling low, again and again. And here is how that gap actually opens up. The more often you look, the more often you panic. A behavioral study found that investors who check their portfolio every single day are 5 times more likely to panic sell during a downturn than those who check only once a quarter. The market did not hurt them. Their own eyes, glued to the screen, did, and the cost of panic is measured in real money. In a single recent year, the market climbed about 25%, but the average investor captured only 16%, a gap of more than 8 percentage points, one of the worst in a decade. They withdrew their money during, or just before, the market's best weeks. The growth was right there. Fear pulled them out of it. Mistake number 4 feels like the dream itself: quitting your income too soon. The portfolio is up, so you walk away from the job or the business that was feeding it. But a rising market is not a salary. The moment you stop adding fuel and start living off the pile, every dip becomes a withdrawal at the worst possible time, and the compounding quietly dies. The data on this is staggering. Studies found that around 78% of former NFL players hit financial stress or bankruptcy within just 2 years of their paychecks stopping. About 60% of NBA players are broke within 5. They earned millions, but the income engine switched off and the spending engine never did. A pile without income is just a countdown. Mistake number 5 hides inside kindness: becoming everyone's bank. The moment people sense your money is growing, the requests begin. a loan for a cousin, a rescue for a friend, a stake in someone's dream. The lottery data is blunt. A huge share of winners report relatives pressuring them for money almost immediately. Generosity is beautiful. Becoming an unpaid ATM is how a fortune leaks out. And these leaks rarely look like emergencies. They look reasonable, small, easy to say yes to. One favor at a time. Psychologists who study sudden wealth list this exact pressure as a core trigger of guilt, anxiety, and broken relationships. The money does not vanish in one dramatic loss. It bleeds out quietly, through 100 warm-hearted yeses you were too uncomfortable to refuse. Mistake number 6 is trying to outsmart the market, timing it. Once your money is growing, the temptation to jump in and out, to catch the top and dodge the bottom, becomes overwhelming. But here is a fact that should end that game forever. In a recent year, investors guessed market direction correctly only about a quarter of the time. You are not timing the market. You are flipping a weighted coin, and missing just a handful of days is catastrophic. The market's biggest gains tend to cluster in a few unpredictable sessions, often right next to the scary ones. The average holding period for a fund has fallen to under 5 years, barely half a full market cycle. Investors keep jumping off the ride right before it climbs, then wonder why everyone else got richer. Mistake number 7 is the most boring and the most fatal: skipping the foundation. No emergency fund, no plan, no buffer. It feels harmless when everything is going up, but the moment life throws a surprise bill, you are forced to sell your investments at the worst possible time, just to cover it. The thing that felt too boring to build is the thing that would have saved you. This is the trap that locks all the others in place. Without a cash buffer, a broken car or a medical bill forces you to liquidate at a loss, turning a temporary dip into a permanent wound. Behavioral researchers are blunt about it. Investors without an emergency fund are the ones most likely to sell in panic. The foundation is not exciting. It is the floor that stops you from falling through. So here is the riddle from the start, finally solved. The deadliest mistake looks exactly like winning, because it is the overconfidence that a single win creates. Every trap we covered springs from the same root. One early success convinces you that you have it figured out. Lifestyle, the big bet, the panic trade, the early exit. All of it is that first win whispering that the rules no longer apply to you. That is why the same rising portfolio makes one person wealthy and ruins another. The win itself is neutral. What matters is whether it makes you humble or reckless. Handle it with discipline and a plan, and momentum compounds for decades. Handle it with ego and impatience, and that exact same momentum becomes the rope you hang your future on. The market only reveals which one you chose. Once you see that, the whole game changes. You stop treating your first win as a finish line and start treating it as a test. Can I keep my lifestyle flat while my net worth climbs? Can I stay diversified when one bet is screaming at me? Can I sit still through a crash and do nothing? Master those, and a growing fortune stops being a danger and becomes a foundation. So, before you react to your next win, ask one question that changes everything. Am I acting from a plan or from a feeling? A plan is written down before the emotion hits. Your allocation, your buffer, your rules for staying put. The feeling shows up exactly when the stakes are highest, dressed up as confidence. The investors who keep their gains are simply the ones who decided in advance not to listen to it. So, let us bring it home. When your capital finally starts to grow, the threat is no longer having too little. It is what you do with the first taste of having more. Do not inflate your life to match the win. Do not bet it all on one idea. Do not let fear or greed trade for you. Do not switch off your income. Do not become everyone's bank. Do not try to time the top, and never skip the boring foundation. Every one of those mistakes wears the mask of success, and that is exactly why they work. Here is my honest send-off. The market does not punish the people who have the least. It punishes the people who got a little, and suddenly thought they knew everything. If this saved you from one expensive mistake, do me a small favor. Subscribe. I am Sargon. Stay humble while the numbers climb, and I will see you in the next one.